Welcome back to the deep dive. Today we have breaking news on pension updation and wage review by central government. This update hits two groups differently. For PSB retirees, it's a blow, but for RBI and NABARD retirees, the backdated 2022 announcement is a major financial gain.
No, we aren't talking about maybe or what if. We were talking about ink on paper, government seal of approval, and a massive movement of updation and wage increase capital that just dropped in January 2026. I'm Nisha Bhattacharya and my co-anchor is Priyanka Chakraborty.
This may be one of the biggest public sector financial updates in years, and it hints at what bank retirees could gain if the MC Singla case in the Supreme Court rules for updation.
This announcement by the Ministry of Finance did not tinker around the edges. No, we're talking about a real structural shift here.
Here's the deal. If you work for or if you've retired from the Reserve Bank of India, NABARD, or the public sector general insurance companies, your financial reality just shifted for the better.
It really did. We aren't just talking about a few executives at the top. The scope here is enormous.
How many people are we looking at?
Over 100,000 people comprising of active employees and retirees. And this is crucial because far too often retirees and family pensioners are overlooked.
The statement issued by the Ministry of Finance was dense and bristling with technical formulas. There's a number 11.43 that we are definitely going to spend some serious time on later because I know it's causing a lot of confusion out there.
It is. But as we'll see, it's actually good news, but only if you know how to read the math behind it.
So, our mission today is to decode this package for those lucky RBI, NABARD, and PSGIC retirees and active employees.
The headlines call it a wage revision, but it feels more like a financial dignity in old age package.
For RBI, NABARD, and PSGIC, we're going to help you find the money, explain the new math, and tell you exactly what dates you need to be looking for in your bank statements.
Importantly, getting those dates right is critical because they differ depending on which institution you served.
Okay, the largest chunk of this financial injection goes the insurers, the public sector general insurance companies or PSGICs.
We're talking about the National Insurance Company, New India Assurance, Oriental Insurance, United India Insurance, and the General Insurance Corporation of India, GIC, plus the Agricultural Insurance Company, AICL.
So the big players, the ones underpinning risks for the whole country.
Now, for the active employees in these companies, the headline is a wage hike.
But I saw two different percentages floating around on the documents, 12.41% and 14%. Which one is it?
It's actually both, but they measure different things. This is a distinction that often trips people up.
The 12.41% figure that refers to the increase in the overall wage bill for the companies, that's the cost to the employer.
Got it. So that's the corporate budget view, what the CFO is looking at?
Exactly. But if you're an employee wondering about your specific paycheck, the number you care about is 14%.
The revision provides for a 14% increase on your existing basic pay and DA.
That's a significant jump. And the timing matters here, right? Because these things are rarely instant.
And this is where the finding the money part gets really good. The effective date for this is retrospective. It kicks in from November 2022.
November 2022. Wait, today's date is January 2020. November 2022, that's a substantial back pay.
We're talking nearly 3.5 years of differential back pay. That's a lump sum that changes your year.
Definitely. But while the arrears are great for the here and now, there was something in the insurance section that looked like it was aimed specifically at the younger generation.
Yes. This is a vital detail that might get buried. But structurally, it might be the most important part for the long term. It concerns the National Pension System, or NPS.
And this applies to employees who joined after April 1st, 2010, correct?
Yes. For that group, the government has increased the employer contribution to the NPS from 10% to 14%.
Okay, help me contextualize that. From 10 to 14% doesn't sound like a landslide, but you're saying it's a big deal?
Yes, it's huge. You have to think about this in terms of compound interest over, say, a 25 or 30-year career.
Precisely. It's future-proofing the younger workforce who don't have access to the old defined benefit pension schemes.
It's an acknowledgement that their safety net needs to be stronger.
Speaking of safety nets, we need to talk about the family pensioners in the insurance sector. These are the folks who often get the short end of the stick, right?
Absolutely. They are the most vulnerable group financially, and this specific change is a gesture of appreciation, which I thought was, well, quite a touching language for a financial document.
Family pensioners have moved to a uniform rate and they're now revised to a flat 30%.
Before this change, it was complex, often tiered, or subject to different caps. The change helps over 14,000 families.
That's significant. It's basically saying we're putting a consistent safety net under everyone.
Exactly. And when you tally up the cost of the wage hike, the arrears, the NPS bump, and this family pension revision,
The price tag for the insurance sector alone is staggering. It's over 8,170 crore rupees.
and the bulk of that is arrears.
Yes, over 5,800 crore of that is just to pay off the arrears from 2022 to now. It's a massive injection of liquidity.
I'm happy for PSIC retirees, but if I were a bank retiree, the inequality between PSICs and PSB retirees is a slap in the face.
Okay, so that's the insurance sector. August 1st, 2022 is your magic date. Now, let's pivot. Let's talk about NABARD, the National Bank for Agriculture and Rural Development.
An absolute critical institution. And for you, the listener tracking the dates, shift your mental calendar. While insurance was August, the NABARD revision is effective from November 1st, 22.
Okay, noted. November 1st, 2022. What are the active NABARD employees looking at?
It's a slightly different structure. For Group A, B, and C employees at NABARD, the hike in pay and allowances is approximately 20%.
20%. That's notably higher than the 14% we just saw for insurers.
It reflects the specialized nature of the work they do. But honestly, while the 20% is great for active staff, the most fascinating part of the NABARD update is in the pay raise.
You're talking about the parity adjustment.
Yes, this is a story of equity. It's a correction of a historical anomaly, unless you're a bank retiree.
If you like this podcast, please subscribe, comment, like, and share.
Your subscription helps our channel to produce more podcasts like this one.
The press release made a specific point of saying retirees were being brought on par. Who was lagging behind?
So imagine you have two people who retired from NABARD in the same year, let's say 2015. One of them was recruited directly into NABARD, the other transferred in from the RBI stream years ago.
Okay.
Because of the way the pension agreements were historically structured, the original NABARD recruit was actually getting lower benefits than their ex-RBI colleague.
Even if they did the same job at the same level,
There was a discrepancy based on recruitment history. And this revision, it finally fixes that for everyone who retired before November 1st, 2017.
that is huge. It's fixing a legacy glitch.
It brings those pre-2017 NABARD recruits on par with the ex-RBI NABARD retirees. It's an acknowledgement that the service rendered is equal.
I love that. It's not just about money, it's about fairness. And this also comes with arrears.
It does. There's a one-time arrear payment, over 510 crore for the wage provision, and about 50 crore specifically set aside to pay out these pension adjustments.
So if you're a retired NABARD officer from that era, you need to be checking your statements.
They've probably been waiting years for this.
All right. We've done insurance, we've done NABARD. Now we have to tackle the big one, the mothership, the Reserve Bank of India or RBI.
I must admit, when I first read the RBI section, I got a headache. It's thick with math, formulas, indices, conversion factors.
Okay, I want us to really slow down here and decode this for RBI pensioners.
Agreed. It is complex, but the logic holds up once you strip away the jargon.
So let's start with the headline. What's the basic deal?
Firstly, the government has approved a revision effective November 1st, 22, so it matches the NABARD date.
The core of it is a 10% enhancement on the basic pension plus DA.
Okay, 10% sounds straightforward, but then the document throws this curveball.
It talks about a conversion factor and it gives the number 1.43.
Right. And this is where the panic can set in for some people.
Because in the previous revision back in 2023, the factor was 1.63. Now it's 1.43. A retiree is going to look at that and think, wait, the number went down. Am I losing money?
And that's a very natural reaction, but it is incorrect. You're not losing money. A smaller multiplier does not mean a smaller pension in this case.
Okay, explain that. How can a lower factor be good?
It all comes down to the Dearness relief merger point. This gets a bit technical.
In India, your pension has two parts, the basic pension and the Dearness relief or DR, which compensates for inflation.
Periodically, the government takes a chunk of that DR and merges it into the basic pension.
Right? They bake the allowance into the guaranteed salary.
Exactly. Now, in the 2023 revision, that merger happened at a lower level of inflation at 6,152 index points. Because that base was smaller, you needed a bigger multiplier, 1.63, to get the final number up.
In this new revision, they've shifted the merger point way up to 888 index points.
Precisely. Because the starting basic pension is now significantly higher, the multiplier needs to be smaller to reach the correct final figure.
So, bottom line, the starting pie is much bigger.
So 1.43 is the correct mathematical adjustment for the fact that the starting point is higher.
You nailed it.
It's a balancing act. The net result is still a ton enhancement on the total package.
Okay, that makes so much sense. Now let's get practical. If I'm an RBI pensioner with a calculator, what's the formula?
It's a two-step process, looking at the position as of October 2025.
Step 1.
Take your old basic pension and multiply it by 1.43. That gives you your revised basic pension.
Step 2. You add the Dearness relief, and this is another huge positive change, the formula says, plus 21.13% of that revised basic pension.
21 or 13%. Now wait a minute, didn't calculating DR used to be really complicated? Wasn't there a slab system?
Yes, and everyone hated it. The slab method, basically different parts of your pension got different rates of relief. It was opaque and confusing.
And that's gone?
Yes, no more slabs.
Now it's a flat uniform rate. As of October 2025, that rate is 21.13%.
So old basic times 1.43 plus 21.3%, that new total, your gross monthly pension.
That's the rough math. Yes. And RBI has actually released a specific pension calculator tool for retirees.
And just to confirm, like the others, this RBI update is retrospective.
Yes. Effective date is November 1st, 22. So you are owed arrears for every month since then. A real gift horse.
So we've looked at the math, the factors, the percentages, but I want to step back. So what's the so what here?
It's a good question because it looks just like a payroll update. But if you look at the aggregate data, we're talking about roughly 46,000 active employees and over 46,000 pensioners.
That's a small city of people.
It is. And the total financial implication is massive. But beyond the billions, I think the real story is in the language the government used.
The goal, they said, is to ensure retirees can absorb the cost of living and maintain their social status post-retirement.
Social status is exactly what bank retirees updation are asking for. Why are they treated differently from RBI retirees?
Social status, that is an interesting choice of words for a government circular.
Subsistence means keeping you alive. Social status means dignity. It acknowledges that their standard of living shouldn't collapse just because they're retirees.
That's a powerful distinction. It frames the pension not as a handout, but as a maintenance of professional dignity in retirement.
Exactly. The government is signaling to Gen Z that these is still a premium career path. It's a clever retention strategy.
Yes, because it connects the 14% NPS hike for Gen Z directly to the parity adjustment for the 70-year-old NABARD retiree.
It's one cohesive ecosystem.
Before we wrap up, let's do a quick tactical recap. If someone is going to check their paperwork tomorrow, what are the key takeaways?
Right? 2 dates to burn into your memory. If you were the insurance company's PSGICs, your effective date for arrears is August 1st, 2022.
Got it. If you are NABARD or RBI, your effective date is November 1st, 2022.
RBI retirees shouldn't panic at the 1.43 factor. It's lower only because the base index is higher, and the official RBI calculator gives the safest accurate pension figure.
Summarizing, we saw NABARD retirees brought on par with their RBI peers. We see NPS contributions for new staff hiked. We see family pensions standardized.
This is what harmonization looks like. The only group remaining to join the caravan are MC Singla bank retirees.
It appears there's an attempt to raise the floor for the public sector, young and retirees, which is to be welcome.
Thank you. Bye for now.